The Durable Goods Report was released earlier today. We examined dozens of data points, and for the most part, wasn't too bad, wasn't too good, except for two key metrics. Those are deep in negative territory, and the implications, they're really not that good. Now, durable goods are designed to last at least 3 years, includes products like automobiles, computers, appliances, heavy machinery. It's considered to be a staple of the US economy. So the direction of durable goods is usually the direction of the economy. It can be quite telling. And it reflects the state of manufacturing, housing, the automotive and defense industries, and many others. Now, the durable goods on a year over year basis was released at a negative 4%. And we can see this is following last month's negative 6%. In fact, for the most part, this number has been in negative territory for the better part of 2024 and now the beginning 2025. And that really does reflect a weakness in the manufacturing industry in particular, which we have spoken about. Now, here are the different subsectors broken down, and it's really telling which sectors are doing well and which are not. Computers, that's up 10% on a year over year basis. Defense, up 11%. Also, appliances, that's up 5%. Those are the highlights of the report. Now, here's the bad news: transportation, down 18%. Durable goods, that's the core number, that's down 6%, and then on 17% on capital goods. Now, taking a look at the following chart, we can see these are the four big sectors that we're going to speak about tonight. On the top, we have defense and computers. And for the most part, they're doing quite well. On the downside, we have transportation and capital goods, and they've spent the better part of the past couple years in negative territory. And the divergence is really quite stark. We're going to show you in just a moment what that means, by the way. In terms of capital goods, what are they? They're durable goods used to produce other consumer goods and services. This includes plants, property, equipment, buildings, machinery, vehicles, and tools. These are the things we use to make the goods and services that are ultimately provided. Now, we also have capital goods here on a year over year basis. We can see the current figure stands at negative 13%, following last month's drop of 17%. In fact, for the better part of 2024, with few exceptions, this has been handily in the negative side of the numbers. Transportation equipment is the other big loser in this report. Now, that serves the automotive, aerospace, shipbuilding, and railroad industries. We're talking about heavy machinery and transportation equipment, specifically aircraft, automobiles, and parts. And we can see on a year over year basis, transportation down 13%, following last month's negative 18%. A very similar pattern to what we saw with a prior number as well. And that's really kind of interesting why they're so closely correlated. We're going to show you why we think that's the case. Why is this all so important, by the way? Well, on the left hand side, we see the winners: appliances and computers. On the right hand side, capital goods and transportation. Well, the appliances and computers, they tend to be smaller, less expensive. Capital goods, remember the equipment, the plants, the machinery, those are larger and more expensive, require more capital expenditure. On the left hand side, appliances and computers, these are household expenses. It's not necessarily related to business. It can be, but it also is related to the consumer. And this shows us there is a certain amount of resilience in the consumer. However, the capital goods, we're talking about transportation equipment, heavy machinery, this is almost exclusively reserved to businesses. So when we see weakness in the capital goods and transportation sector, it means there's a lack of orders, there's a lack of demand at the business level, despite any good news the consumer might be experiencing at the moment. Now let's go back in time. This is the financial crisis of '07 through 10, roughly. And we have a key at the top here: capital goods in blue, computers in yellow, transportation in white, appliances in red. Now notice during the bleakest days of the 2008, 2009 recession, what was at the bottom? Transportation, like now, and also the blue line, capital goods, like now. Of course, computers and appliances, they were also down to some extent, but of course, it was a recession. Everything went down. But the key takeaway from this is that during a recession, those those equipment, those pieces of transportation that are more expensive, that take quite a bit of investment. Those are the ones that really suffer first. That's what we saw in the '08 recession. Well, fast forward to present case, that's what we're looking at now. The white line, transportation, the blue line, capital goods. And they've been in negative territory for the better part of a year, with few exceptions, and it doesn't look like they're recovering anytime soon. Now, the computers are strong, somewhat, and the appliances as well. That shows us the consumer is still in the game. But as far as business investment, this divergence is pretty stark. Now, coming up this week, we have a lot of big news. FOMC rate decision on Wednesday, GDP on Thursday, and Friday, inflation, personal consumption expenditure. And what we mentioned in the past week or so is that we're watching the 10-year bond and the Fed funds futures very carefully, because that is very telling as far as their reaction to these numbers and the future possible trend of the market. We hope this has been helpful. We look forward to seeing you back soon.